Recording. So, learning outcome 2, strategic sourcing. Sorry, that's the old 2.3. So we're looking at industry dynamics, which is Porter, pricing, and guess what? Financial data on suppliers, which could mean, it means everything. And some sort of stakeholder, guess what's going to be in there? Internal, external, connected, Mendeley. So dynamics, oh my grief. Processes through which industries change over time, good grief. Right, so the dynamics of an industry we understand by looking at the 5 forces. So it's not a static, so you know who's leaving, who's coming in, what's happening. So we understand market dynamics. You talk about for explored in depth in the study guide, pages and pages of it. In the middle box, of course, we could have different industries, monopolies, oligopolies, perfect competition, hyper competition. So that's fairly straightforward. The industry life cycle affects competition, whether we're at the development stage, growth, shakeout, maturity or decline. That impacts on market dynamics, it impacts on pricing, and you can see how it impacts on the 5 forces at the bottom there. So as well as talking about the 5 forces, remember when you look at each area to throw in this is an important influence. That talks about the cycles of competition. Now you can get price wars when new people enter the market. It worries me there's a soundtrack on this one. We've had that slide repeats, well done Dave. And you can see there that just shows cash and profit at different times, that initially you're losing money, it's not till you've got growth that you start making money. And obviously the stage of the life cycle will affect how many suppliers you've got, the pricing in the market. Market segments, what are the problems with them? I'm not sure that. Right, pricing behaviour, what affects price? Value, costs, competition and firm strategy. Some books say there's 3 things, some say 4. Often that's shown with a nice balloon with them 4 things coming out, things that affect price. So it isn't just about cost, it isn't only about competition, but it can be all them things. But O'Brien's is okay, so and skimming would be done probably on new products or penetration, you take your pick. Do you go in high or do you go in low for market share? Where psychological and the others would be used for ongoing. Cost reduction, pretty straightforward. How to reduce costs in supply chains, working together, eliminating waste. I don't know how these slides are repeating, it's a bit of a puzzle. So how do we praise financially? Oh, right, good stuff. I'm puzzled. Right. Why do we do it? What do we do? We need to consider financial standing as part of risk assessment, and we know why we need to do it. So the income statement then used to be called the profit and loss account. If you think it was that, that's the best way to think of it.
Income statement is profit and loss?
Yeah, it's the same thing. It's the new name for it in international accounting standards.
Oh, is it? Oh, okay.
Yeah, and that's a basic income statement. But you need to understand this. The top line is the income coming in, or revenue or sales as you'd probably call it. But the posh word is revenue. So the top line in business is how much have we sold last year, and the bottom line is your profit. And in between are various costs. So if you've got top line growth, it means revenue's gone up, which is good. Your cost of sales is what the procurement people have spent buying stuff in, if you're a retailer or a manufacturer or whatever. And then you get gross profit, take away your overheads, just think of them as overheads only, and that leaves you your operating profit, and that's it. So income shows, guess what, income, but it also shows costs. And you could say another word for operating profit is net income. So this is your gross income, if you like, your revenue, take away your costs. So that word income is a bit misleading, because income can be what you're left with. Income from money coming in. I think it's better to think of the word income is sometimes used. At university we might call it surplus in some industries if you're a charity rather than profit.
Be looking at?
Just basically, they'd say, why might you need to look at an income statement? And you'd have to be able to say, well, from that we can see whether their revenue is increasing, decreasing, whether the gross profit margin's going up or down, and whether their net profits are increasing. So it's just a very basic understanding of, you wouldn't have to say it would then have distribution cost, admin cost, you would just say other overheads are deducted to get profit before tax, say, then after tax you've got profit after tax. There's another example just of a simple statement. So it only shows income, costs, and that's it. And there's a real world one from Morrison's, which shows top line turnover, gross profit, other costs, and an operating profit. And you can see the top line went up slightly and the profits went up slightly. So you don't have to drill into, because the income statement doesn't show the value of your land, your equipment, how much debt you got. So it shows the assets, the liabilities, the equity, just 3 things. But it's more complex. But when you look at one, so assets are things you have that are going to give you benefit. There's things that are solid, equipment that are long term, and there's some that's going to be used up. Stock, money owed, and you owe money, overdrafts to your suppliers. Long term debt can be bonds, loans, etc. And you don't call it long term nowadays, you call it non-current. Used to be called long term. Some assets can be intangible, patents. Right, let's have a look at a balance sheet. So that's all it is top line is non-current assets, you add your current assets, you take away something and that equals capital. It doesn't mean a lot. You can look at the top line, the bottom line, and after that you're stuffed really. It's too complex. So we need ratios. Much easier to just compare different companies, so they'll help us understand it. So many benefits of it, provide quick means, and we've done the ratios before. And I think in here, so we've got profitability ratios, efficiency, liquidity, gearing. So we've got the profit ones, ROCE, gross, operating, and I've standardised the formulas so that we haven't got this silly average rubbish. So it is just a straightforward one figure divided by another. Oh yeah, I've got to. That slide's come out bad. I'll change that, but there are 2 formula on there. One showing average inventory and the other how to calculate. So we've got the standard measures, trade receivable days, settlement days, trade payable days, liquidity. And of course that was the question, so we probably need to revise how to do those. And somewhere down here we've got 2 ways of doing gearing, and eventually we come to a slide. We don't need these shareholder ratios. Limitations of ratios, we do need that. That's the summary from the study guide from my notes. And if you'd understood that list of ratios they gave you, as long as you knew what the ratio was, you could make a good stab if you'd learnt that ideal result and looked at the movement. So the current ratio probably should be nearer 2 if we're being honest, but it depends on the industry. Gearing depends on the trend. I think they're fairly obvious, aren't they? We want the profits to be going up. We want the current ratio to be stable. We want the acid test not to be less than 1, etc. So I think they're fairly okay to go with. We've got the dreaded steeples or steepled. Boston Matrix, not keen, but it's a way of looking at your portfolio. You know, Oxford College might say, well, you know, this particular qualification they offer, you know, it used to be a good seller, it isn't now, the market's shrunk, it's not growing, with a low market share, the market's not growing, so it's time to pull out. SWOT, I'm not going to go down SWOT. Value chains we've covered many times, and that's a very poor map of Porter's value chain. So it's showing the supplier's value change, your value adding, and the distribution. Supplier preferencing can be important as to how they see you, as whether you're a key account, and again that's been examined many times. What makes you attractive? Well, depends if you've done your makeup tonight, but yeah, pretty obvious stuff. But yeah, you know, are you a good payer? Have you got a good reputation? Is the future business? Put that chart in Racy and Mendelot. So the Mendelot matrix needs putting in there.
Okay.
Assessing stakeholders. And Racy, I think we've done that before, haven't we? The roles.
Yeah.
So Racy's in the. And then we've got this: how long a contract should you have? Well, depends on the product. Number of suppliers. So you can have bespoke or standard contracts. We can have spot, short term or long term. And there are advantages of short term, disadvantages, pretty text. One for bottleneck and strategic items referring to your CRALJEC. EU directives will impact in public sector how long you can contract for. How do you reduce time? Not really current. Negotiation can be used, obviously. But we might use competition. When? There. But we might just want to negotiate. Should we use competition or should we directly negotiate? Depends. And there are advantages and disadvantages of using competition and negotiation. Guess what? What's in an RFP, RFQ? Again, that's been examined before. Very simple. Supplier selection, REITs, use of e-auctions, e-technology. The textbooks. It's been on the syllabus before and it's on now.
What is that? Joint proposition improvement?
Yeah, it just means you agree to work together to improve some aspect of the supply. So it's almost like a partnership, but it isn't. It's almost supply development, but it's joint. But it's a joint thing you do together, where the buyer and supplier work together to improve how they're working together.
Okay.
So it could be to upgrade. It allows the incumbent supplier with experience to offer insight and re-engineering. It might be over informal. The disciplines of change management, cross paths. It's a very strange idea. Benefits though: innovation, quicker to market, improved delivery. Both organisations though need to be transparent and fair, but there's risks. If you develop something together, who owns it? Who owns the intellectual property right? How do you exit the contract? It could be difficult. The relationship could be difficult to manage. Price increases, late delivery, reputation damage can cause.